There is an emergency building in the Australian dollar right now. While the daily chart is still screaming strong buy, the short-term timeframes have just flipped into a strong sell, and a geopolitical shockwave is tearing through the Aussie risk trade. Today you are going to see one danger zone that can liquidate late bulls, and one hidden opportunity that can deliver 100 pips if you read the structure correctly. Stay until the end. I'm giving out 3 exact entry and exit levels you can use immediately, including the level where breakdown triggers a collapse to 0.7080 right now. Australian dollar to US dollar is trading at 0.7223, but that number means nothing without the crosscurrents behind it. The instant market verdict is this: the daily trend is a strong buy, the 4-hour trend is a strong sell, and we are fading the daily strength into a support zone. The session bias is to respect the short-term momentum while the price is trapped below the 4-hour moving averages, but with the understanding that a bounce from the 0.7190 pivot would aggressively reactivate the daily bull trend. The one invalidation level that proves this whole structure wrong is 0.7190. Write this number down now. If we break 0.7190 today with a 4-hour close below, the entire daily bullish structure shifts. The next stop becomes the 60-day moving average at 0.7120, and then the 200-day at 0.7000. That is over 200 pips of downside. So everything hinges on 0.7190. Drop it in the comments right now. Do you think 0.7190 will hold or fail today? I'll be reading those. Let's walk the chart from the top down because that's how the institutions see it, and that's how you will see the trap. On the weekly time frame, Australian dollar to US dollar remains in a multi-month uptrend. Price is above the 200-week moving average near 0.6850, and the 20-week MA has crossed above the 60-week, giving a long-term bullish alignment. The weekly MACD is positive and still accelerating higher. No divergence there. That tells us the underlying tide is up. The daily chart confirms this with a strong buy signal. Price is comfortably above the 20-day MA, which is currently sitting at 0.7180, just below that 0.7190 support we are talking about. The 60-day MA is at 0.7120 and the 200-day MA is at 0.7000. All 3 daily moving averages are sloping higher and fanning out. This is a textbook bullish setup. The daily MACD is still above the zero line, but here's the first crack. The histogram bars are shrinking, momentum is decelerating. Buyers are getting tired. That's the first hint that the daily trend might need a deeper pullback before it can extend. Now drop down to the 4-hour chart, and that's where the trouble starts. The 4-hour trend has flipped to a strong sell. Price is trading below the 4-hour 20 MA, which is right around 0.7245, and that 20 MA has crossed below the 60 MA. This is a classic bearish alignment, the shorter-term average falling under the longer one. The 4-hour MACD is printing lower lows beneath the signal line, and we have a clear negative divergence from the last swing high. Price made a higher high near 0.7290 a few sessions ago, but the MACD made a lower high. That divergence already warned of exhaustion, and now we are seeing the resolution with this sell-off. On the hourly chart, the price has sliced through the 20 and 60-hour MAs, both of which are rolling over. The 200-hour MA is down at 0.7160, adding an extra magnet if the breakdown accelerates. So the multi-timeframe picture is daily bullish but losing momentum, 4-hour bearish in control, and hourly confirming the short-term sell. The battle zone is right here, right now, between 0.7210 and 0.7190. Here's what most traders miss when they only look at one time frame. The support numbers you need are 0.7210, which is the low of the Asian session and an intraday pivot, and 0.7190, which is a confluence of the broken 4-hour swing high from last week and that daily 20 MA we discussed. If 0.7190 breaks, you also lose the psychological round number handle and you trigger a lot of stops. Resistance sits at 0.7274, which is the overnight sell-off breakdown point, and 0.7294, the recent swing high that failed to hold. So the range is tight but explosive. The fundamental driver today and why this matters for the cross-asset web is the Gulf crisis. Over the last 24 hours, we got news that Australian and New Zealand firms, from airlines to banks, are feeling the heat of rising tensions in the Gulf. This isn't just a headline, it's a direct risk-off shock for the Aussie dollar. AUD is the China proxy, the risk barometer of the currency market. When global risk appetite cracks, the Australian dollar sells off, period. We saw iron ore futures dip overnight, the Shanghai Composite under pressure, and the yuan weaken. That's the transmission mechanism. And if you're watching the other assets I cover daily, US dollar to Japanese yen and Nike 225, you will see a confirmation. US dollar to Japanese yen is edging lower as a haven bid, and Nike futures are dropping, consistent with risk aversion. That's mutual validation. When the Nike falls and yen strengthens, the Aussie typically suffers. So this isn't an isolated AUD move. It's part of a broad risk-off wave that is testing the daily bullish structure. The 1 to 2 week directional lean is this. Unless the Gulf tensions de-escalate quickly and we get a stabilization in Chinese equities and iron ore, the Aussie will struggle to reclaim 0.7274. The daily uptrend is intact as long as 0.7190 holds, but a break below that level would invalidate the near-term bull case and shift focus to 0.7120 and possibly 0.7080. The event that would invalidate this caution is a 4-hour closeback above 0.7245, above that 4-hour 20 MA, which would signal the short-term sell pressure has been absorbed and the daily buyers have returned. Otherwise, expect pressure. Now, most people will skip this next section, but this is where money is made. Keep watching. We are going to lay out 3 strategies that cover every scenario, from the conservative sniper to the high-risk counter-trend play. Before that, here's your second interaction trigger. Type your Australian dollar to US dollar range for the next 24 hours in the comments right now. I want to see how aligned we are. I'm reading every single one. Strategy 1, the sniper, conservative. This is the highest probability setup for those who want to trade with the daily trend, but need confirmation that the 4-hour sell pressure is over. We do not try to catch a falling knife. The trigger condition is a 4-hour candle close above 0.7245, which is the 4-hour 20 MA, and ideally a close above 0.7255 to clear some minor resistance. Confirmation signal, the MACD on 4-hour curling up and the RSI breaking back above 40. Stop loss goes at 0.7190, exactly below the pivot, which gives a 55 pip risk. Target 1 is 0.7274, the overnight breakdown point. That's a 1 to 0.9 risk reward if you enter at 0.7255, but the risk reward improves if you wait for a pullback entry after the breakout, which is the discipline of the sniper. The more aggressive version inside this conservative frame, after the 4-hour close above 0.7245, wait for a 1-hour pullback to 0.7230, which is the former resistance now turned support. Enter long there with a stop still at 0.7190, target 1 0.7274, target 2 0.7294. That gives you a risk of 40 pips for a potential reward of 44 to 64 pips, a solid 1 to 1.6. What voids this setup? Any new headline. Escalation in the Gulf that sends risk assets tumbling, or a failure to hold the 4-hour close above 0.7245. If price immediately reverses back below 0.7230, the sniper stands aside. Strategy 2, the active trader, standard. This one is for those who want to engage the support directly with a tighter stop and a clear invalidation line. The entry condition is a bullish rejection wick on the 1-hour time frame at the 0.72100.7190 support zone. Look for a pin bar or a bullish engulfing candle that shows buyers stepping in. The exact entry is on a 1-hour close above the high of that rejection candle, typically around 0.72 to 0.7225. Stop loss goes at 0.7185, just below 0.7190, protecting against a false break. That's a 35 pip risk. Target 1 is 0.7250, which is the mid-range level and the hourly 60 MA, giving a 30 pip reward. Target 2 is 0.7274, the major resistance, offering a 54 pip reward. Once target 1 is hit, move the stop to break even and trail it by 20 pips behind the 1 hour 20 period moving average. This way you let the daily trend work for you while managing risk tightly. The reasoning behind the stop placement: a decisive breakdown through 0.7190 would trigger a structural shift, and you don't want to be long below that. The active trader's edge is reacting to price behavior at the zone, not predicting. Here's your third interaction cliff. Let's see if you're really paying attention. Comment 0.7190 is the line if you're using that level as your bull bear. Pivot. I want to see the conviction in this community. Now, for those who want the high-risk play, stay with me. Strategy 3, the Aggressor, high risk. This is a counter-trend short on a breakdown, and only for those who know how to lose small and manage risk aggressively. The daily trend is still a strong buy, so understand you are fading the larger structure. The trigger is a 1 hour candle close below 0.7190, confirming the break of the pivot and the daily 20 MA. Stop loss is placed above the breakdown candle at 0.7220, which is the session high before the break. That's a 30 pip risk. Target 1 is 0.7150, the next intraday support, giving 40 pips. Target 2 is 0.7120, the daily 60 MA, for a 70 pip reward, a risk reward of over 1 to 2. But here's the explicit warning: the sniper and active trader setups are waiting to buy this very dip. If 0.7190 breaks and then rapidly reclaims, you will be trapped in a bear trap. This is a momentum chase. You must be prepared to exit immediately if the 4 hour candle closes back above 0.7205. Use a tight mental stop. Aggressive doesn't mean reckless. Never risk more than 1% of your account on this. Let's do a quick risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news, like sudden Gulf escalation headlines or Chinese data. Stops are non-negotiable. The moment you think, I'll give it a few more pips, you've handed control back to the market. Now to close the session. The one most critical level for the next 24 hours is 0.7190. Everything else is secondary. If you wake up and Australian dollar to US dollar is above 0.7190, the bull trap thesis stays alive and the bounce play towards 0.7274 is on. If you wake up and it's below 0.7190, the daily structure is cracking and the short side takes control for a move to 0.7120 and potentially 0.7080. Tomorrow's focus will be whether the Gulf crisis headlines escalate further and how Nike and yuan react during the Asian session. If the Nike dives, expect the Aussie to test 0.7190 hard if you want the full breakdown on Bitcoin and the S&P divergence, because that risk-asset correlation is misbehaving right now. That video is live now, check the end screen. Smash like if this analysis gave you a clear, executable plan for today. Subscribe and hit the bell for daily coverage of all 8 key assets. I'll see you in the next one.